How's it going, everybody? Welcome back to a brand new YouTube video. Today, we're going to be discussing the three critical concepts that I believe all of you as traders should 100% understand. Now, the reason why I'm making this video is because I've been trading for over 5 years and I've essentially seen almost every strategy under the sun that you can think of. The old ones, the new ones, the old ones that are reskinned and packaged and sold as if they were new. And from my personal experience, what I've really noticed is you don't need 10 different concepts and 10 different confluences to be able to take effective entries. If anything, that's actually going to hurt your entries because you're overcomplicating them, when in reality, it's better to keep it simple. And that's exactly what we're going to be diving into today's video. Now, before we get into the core content of today's video, I did want to go ahead and mention that we have an absolutely free Discord with a free course that we made in-house that actually goes over the concepts that we're going to discuss right now in greater detail and the concepts that we use on a daily basis to actually be able to execute. And more importantly, we actually have a 7-day free trial so you guys can see exactly how we execute Monday through Friday for absolutely free. If that's something that intrigues you, go ahead and check out the link in the description below. Now, the three core concepts that I'm referring to are going to be liquidity, market structure, and areas of retracement. Okay. And we're going to be breaking these down individually and then actually showcasing an example of a trade that you could have taken when you put all of this together. Now, starting off with liquidity, this is often a concept that gets overcomplicated and misconstrued when in reality, it really doesn't need to. It could be extremely, extremely simple. The way I want you guys to view liquidity is essentially as pools of money on the charts. These are areas on the charts which are often going to be key swing highs and swing lows. And these are areas where price is likely to gravitate to. These are areas that price is going to move to first. And two, these are also areas that price can potentially manipulate. And we're going to talk about that because that dives directly into market structure, and how we're actually going to go ahead and confirm these manipulations is going to be through a break of structure. But before we get into all of that, let's go ahead and actually visualize the concept of liquidity with some examples on the chart. Now we're on ES on the 1 hour, and I quickly just wanted to visualize the concept of liquidity further so you guys can actually have some visual examples before we dive into the next concept. So, like we mentioned, right, these are going to be key swing highs and swing lows that should stick out like a sore thumb. Now, the liquidity sitting above swing highs, key swing highs, is going to be called buy side liquidity, abbreviated BSL, and the liquidity sitting below significant swing lows is going to be called sell side liquidity, abbreviated SSL. Now, the main thing here that I want you guys to focus on is see how price is moving towards these areas with aggression and speed, and ultimately having some sort of major reaction to and from these areas. What I would recommend for you guys to do if you're still having some sort of trouble understanding liquidity and actually more importantly pointing it out is just go through the chart on a higher time frame first to be able to actually visualize the concept and see, mark out these areas and see how is price reacting at these key swing highs and swing lows. For example, right here we have stacked relative equal highs because these highs are relatively close to one another, relatively close to being equal. So I want you guys to view this as essentially double the power, right? Price is likely to target this area with higher probability and move through it with some sort of speed and aggression, which we see right there. Right here, we have another key swing low. So once, for example, price action is able to break structure, what is the next area that we're likely going to move to? The next pool of liquidity that we're at least going to move to is going to be the significant swing low, which as we can see, we end up absolutely annihilating. If we continue going back, we have another swing low right here that ends up getting targeted when we break structure to the downside, and then we end up actually reversing from this area. And this is something that a lot of people just view liquidity as, oh, these are swing highs and swing lows where we're going to be looking for reversals. And that's only one part of it. That's why I mentioned that these are areas where price can likely draw to as overall targets, gravitate towards these areas. And then, yes, these are also areas where we could see potential manipulations. And the way that we're actually going to confirm that is going to be through breaks of structure, which is going to be a perfect segue into actually explaining market structure. So let's go ahead and dive right into that. Now, diving into market structure. Market structure is one of the most pivotal and fundamental concepts that all of you should already understand. But to give a quick recap, market structure essentially refers to the way that we recognize trends, right? It's the concept that we use to be able to identify trends within the market. And we know that trends, right, there's mainly two types of trending markets. We have an uptrend, which develops with higher highs and higher lows. And then we have a downtrend, which develops with lower highs and lower lows. These are our trending markets, but we also know that markets don't have to trend, right? We're not infinitely moving in a straight shot up or in a straight shot down. markets can tend to consolidate and essentially trade sideways between a respective top and bottom. That is all market structure really is. This should feel like a review because it is a simple concept. But what we're really focused about here is not just market structure, but actually being able to recognize when structure is shifting and what signatures price action actually shows us to be able to identify a reversal with higher probability. And the way that we're going to do that is through recognizing breaks of structure. Okay. A break of structure is essentially price action and structure, right? Showcasing us that we are now shifting out of what we were trending in previously, and we could now be trending in the opposite direction. And I say could be because it's a potential, right? A break of structure does not necessarily mean, especially on the lower time frames, that you are indeed going to reverse. That's why you pair other concepts and confluences with that. But this is essentially the concept at its core, right? This is a perfect example of a break of structure to the upside because we were previously trending to the downside with lower highs and lower lows, and we have price action is able to take out and close above the previous lower high, indicating a break of structure to the upside. And what I drew here is after that break of structure, we saw price action put in a higher low and then ultimately follow through to the upside after that break of structure. But that's essentially what a break of structure is going to allow us to do. Let me go ahead and I'll quickly showcase an example of a break of structure to the downside. So that would be price action is trending up, higher highs, higher lows. And then we have price action take out and close below the previous significant higher low, which as we could see was this one right here. And that is going to be our break of structure to the downside. And this is important to understand because if you guys were paying attention, I mentioned that this breaks of structure is exactly, how we're going to be able to identify manipulations at areas of liquidity. Liquidity sweeps are going to be essentially validated through breaks of structure. All right. Now let's wrap it up with the third and final concept, which is areas of retracement. Now, the third and final concept is going to be areas of retracement. And all areas of retracements are essentially areas, right, where we're looking price action to pull back into for us to be able to take an entry from, paired with our other concepts and confluences that we have for our entry model. And that could be anything from as basic to of the golden pocket on the fib tool to a normal fair value gap to an inversion fair value gap, or a mix of one or two of these together, or all of these together. Now, you don't need for all of these to be stacked together to be able to actually take a trade. But just once again, these are essentially concepts that can be used interchangeably and actually together in conjunction with one another. Now, interchangeably does not mean that they are the same thing, but they are all under the category or the cohort essentially of areas of retracements, which, like I mentioned, are simply areas where we're looking for price action to pull back into for us to then potentially take an entry from. All right. With that being said, now that we've covered the three core concepts, let me actually showcase an example of putting all of this together and how we could actually do so to be able to take an effective entry. All right, so we're here on the 1 hour on ES, and I'm going to simply be making use of the replay tool on TradingView, and we're going to be analyzing where price action is at right now, what it could potentially do, play it out, and then actually go piece by piece how we see these concepts presented themselves and how we actually put them together to be able to take an entry. So on the 1 hour, what we see is we actually broke structure to the downside, right? And we were able to take out these significant lows right here, okay? So with that in mind, we are currently trending to the downside, right, on the 1 hour on a higher time frame. The lower time frames are obviously going to be aligned with that, okay? 15-minute, 5-minute, 2-minute, so on and so forth, right? We know that these lower time frames are going to look bearish as well. So what we can expect price action to do here is based on where we're currently trading at right now. And what we've seen is that we were able to take out these lows, but we did indeed break structure to the downside. So we could potentially draw lower, for example, down to these lows, right? Because we understand liquidity. This is a significant swing low that stands out. And we also have this low right here. So depending on how much aggression we actually see on this continuation down, right, we'll be able to see and gauge with high probability whether we're simply going to come down to this low or potentially take out both of these. But right now is not a point to think, oh, I'm going to be looking to take a trade. We simply understand that we are trending to the downside on the 1 hour. We have taken out some of these significant lows and we could potentially draw lower down to these lows. All right, so this is the concept of liquidity. Let's go ahead and play out price action. And boom, what we see. All right, let's actually go back because that is exactly what we're going to want to see. But if we go back, right, what do we see? We see price action was able to come down and take out both of these significant lows. Beautiful. We have now met a pool of liquidity, a sell side pool of liquidity while we were trending to the downside. So, what we could potentially start seeing here is if we're no longer going to continue dropping, which would mean we essentially take back all of this move, right? We can expect price action to have some sort of bounce or potential bounce from these areas, especially if we're manipulating these lows, which we are already seeing a sign of on this 1 hour candle right here, which is essentially printing that beautiful bottom wick and closing right here. Since up close candles close at the top of the body, we are closing right here, sweeping out all of these lows, taking out that liquidity, which further reinforces the potential thesis of us bouncing and starting to potentially reestablish structure to the upside after we've taken out sell side. But what do we know? We are going to confirm this manipulation of a sweep of liquidity with a lower time frame break of structure. So let's go ahead and drop on a smaller time frame and confirm that and actually take a look at that. All right, so I'm now on the 5 minute, and as we could see, these are the both sell side levels that we had ultimately marked out back here. And what we can see on the 5 perfectly is that after we ended up taking out both of these levels of liquidity, we had a quick V-shaped recovery with a break of structure in that same leg. And I say V-shaped recovery because we ended up coming down and we recovered essentially relatively quickly, right, within that time frame that we're looking at, essentially giving us that V-shaped recovery. And in that same leg that we recover after taking out liquidity, we immediately get our break of structure to the upside because price action was able to take out this previous lower high and close above it with some nice momentum, as we could see right there. So boom, we have the break of structure confirming that sweep of liquidity. The last step, the only thing that we are missing now, right, is we have the break of structure, right, which aligns with the sell side manipulation. This is all a narrative for a potential long, right, a potential long here. The last thing that we would need is some sort of retracement back to a key area of interest. And we have one right here beautifully as a 5 minute fair value gap. Let me go ahead and use the basic rectangle right here. We have a 5 minute fair value gap that we can see right here, a 5 minute bullish fair value gap. So all we can do now, right, is essentially wait for price action to tap into that 5 minute bullish fair value gap for us to go ahead and take a long. So if we play out price action, boom, we retrace right there. We're going to go ahead, buy 2 contracts. Our stop is going to be right below that bullish fair value gap where we went ahead and took our entry. We ended up getting filled a bit higher on the close of that up close candle, but that's okay. That's expected. We are on replay. And simply what we're going to do is target these highs right here, this external draw, right? We've taken out sell side. We have now had a break of structure, so we can expect price action to potentially draw to the opposing pool of liquidity for the long side, which would be this buy side right here. And we can place it with a nice money sign. And when we go ahead and actually place our TPs, this gives us a nice 2.9 risk reward, more than what we need. We usually would like a 2 RR, and that's A-okay. And when we go ahead and play price action out, we can see we get that push, we get that retracement, and then ultimately ends up absolutely smacking our TP. And all we did was put together the 3 concepts that we went over. It is that simple, guys. You do not need to overcomplicate your entries. With that being said, that's essentially going to wrap up this video. I hope you guys were able to get something out of it. And more importantly, what you should be leaving with is there's no need to overcomplicate your entries within the market. There's no golden strategy. So make sure you're using concepts that resonate with you, that you are able to understand. And as long as you have a properly back-tested strategy and entry model that showcases that you have an edge, everything else to you should be simply noise. Okay, so that is going to be it. Stay safe, guys. Stay blessed, and I'll catch you in the next one.